UTI AMC, India's oldest fund house, perhaps has seen many transformation and transition. Now UTI AMC is all gearing up itself to unlock the shareholder value and coming out with an IPO. What is going to be the roadmap, and perhaps would UTI Mutual Fund be the first fund house in the country to start trading in the stock exchanges? To discuss all that and give a perspective, we have with us Managing Director of UTI AMC, Mr. Leo Puri. Mr. Puri, thanks for sparing this time as always and speaking to ET Now. If I could ask you, Mr. Puri, how close are you, or what stage is the IPO planning of UTI AMC, because it's been in the pipeline for a very long time now?
I think it remains the preferred option as regards all of our shareholders. And as we have publicly stated, our board had passed resolutions on this some time ago. There is today broad consensus that the right way forward is to list the company on the basis that this will offer price discovery, a valuable exit, capital for the banks, and allow the governance of the company to develop into a board-led independent asset manager. So I think that is now well accepted. It has also been established through the process of an independent banker that there would be an attractive listing possible, that the demand is there, that a company such as this has the track record, the strategy, the financial strength to be welcomed by investors, both domestic as well as foreign. So the feasibility of a listing has also now been clearly established. So essentially what remains now is to find a format, the right contours for a listing. How will the listing be structured? What would the level of participation be? What would be the extent of shareholding that will be offered? Who would participate in that? Is it purely an offer for sale versus also including some primary capital? These are the questions which are under discussion. We naturally want to do this in a way that will be a win-win for all of our stakeholders. So our shareholders must see and welcome this, and there should be total consensus on this. And we think we are very close to that point.
Okay. Mr. Puri, interestingly, as you're rightly mentioning, four primarily PSU companies hold 18.5% each: LIC, SBI, BOB and PNB. And of course, we know T. Rowe Price holds the majority in this particular format. What is the indication coming from the current shareholders in terms of preference? As you're rightly saying, OFS would be the ideal way, perhaps when these guys want to exit. One aspect, what are their preferences? What are the indications coming in? And even from T. Rowe Price, what are the discussions, whatever you had? And secondly, sir, the timing, because that is what everyone is anticipating. Would FY17 still be a realistic time frame where you are confident that you could perhaps attempt and we could see the IPO happening?
No, since the views are in the process of being formulated, I wouldn't wish to comment on individual shareholder views at this point, beyond saying that there is broad consensus that some form of a broad-based listing is indeed the right way to go. And that is a view that is shared both by our shareholders, of course, by our board, and supported by the Ministry of Finance. So it may be touch and go in FY17. Calendar year 17, of course, I certainly hope so, very comfortably, but I don't think we are too far away now.
Okay. Mr. Puri, if I could quickly also touch upon, after you took over, clearly there has been a lot of transformation, a lot of changes. We all know how you have been moving up the ladder when it comes to vis-a-vis the competition. In terms of valuation, how do you see UTI AMC with the kind of assets under management that you have and the kind of benchmarks that are there for the industry on an average? How do you see the valuation panning out for you?
Well, again, since this will be a matter for the bankers to determine, I can essentially say that if you look at where we are today, we are fairly close to, as an AMC, we have close to 3 lakh crores at this point. If you take 1.3 lakh of AUM, domestic AUM, we have pension assets, we have offshore assets. So we end up with about 3 lakh crores in total assets. I leave you to sort of determine what that might be worth. We have a very healthy equity mix in our domestic portfolios. More than 1/3, 35% or so is equity balance products. We are one of the more profitable AMCs. So on an earnings basis also, I think we look very, very strong. We have very healthy reserves. We have reserves of 1,700-1,800 crores. We're probably the best capitalized AMC in the industry. I think we are the best capitalized, and we do have therefore very, very strong net worth as well. We have a business model that includes not just domestic mutual funds, but is diversified into pension, both EPF and NPS. We have a strong, perhaps the strongest international business of any of the Indian mutual funds. We have a successful alternative business in the sense of UTI Capital, and we intend to launch alternative funds, private equity funds on that as well. So taking all that into account, I'm quite certain numbers, I wouldn't like to put a number on it, but let me just, as a very conservative indication, say this would be certainly well north of $1 billion is certainly where this will be.
Put it very nicely, and that's what everyone was looking at. So if I could also ask you, how do you see FY17 panning out for you? Because we all know FY16 in that sense has been a real good year after 2 to 3 years of challenging times. How do you see you closing FY17 from the way things have panned out in the first half?
First half has been very good for the industry. It has been an exceptional period. There has been some reallocation from equity flows to fixed income flows and balance flows as well. And that's to be expected, because as the market cycles go, you see this reallocation happening. It's a healthy process. Second half may be a little tougher. Equity flows are slowing for the industry. It could be a sense that maybe the rate cycle is bottoming out, so we may not see perhaps the same flows that we saw earlier into duration funds, where people who were wanting to capitalize on fixed income funds through rate cuts, they may also slow down, and you'll see more accrual type products picking up. But overall, I still think this will be a year where it would surprise me if the industry growth were below 25%, and which is a very healthy number for us as an industry. And UTI would certainly, we hope to do at least as well, if not a little better than the industry this year.
Okay. Mr. Puri, another important milestone that UTI as a AMC is celebrating is the UTI Master Share, which has completed 30 years. And clearly you are saying that if you are invested, if my numbers are right, 10 lakhs, clearly it should have been worth some 6.6 lakh crores. Would in that sense UTI Master Share will be the benchmark for a retail investor to see how long-term returns can be in a mutual fund?
Oh, absolutely. I think it's actually something which not just UTI, the whole industry should be celebrating, because it is the mother product and represents the creation of the open-ended mutual fund. The true mutual fund, an NAV-based fund, did not exist until Master Share was actually launched by UTI. In that sense, it is truly the first fund, mutual fund launched in India. And it has generated over 15% per annum through investing essentially in large caps. So you have to take into account, of course, there have been periods where mid caps have performed very well in India, but they have typically done so with high volatility. But despite the fact that this has been focused on high quality, blue chip, large cap funds, more than 15% per annum, and this has outperformed the BSE Sensex by about 1.25, 1.3% as well, year on year. So alpha has been generated. And to give that some perspective, if you had put that same 10 lakhs into a fixed deposit, today you would have 1.75 crores. If you had put that money into the BSE Sensex, you would have around 4.8 to 4.9 crores. You put it into Master Share, you would have got nearly 7 crores. You were around 7 crores. So it just gives you an idea of the power of compounding, what a middle class household can do by essentially being consistent in the way that it has saved and by taking the long-term view. This is a product with low risk. I should add that throughout this period, the product has delivered a dividend, which is very noteworthy. Every year we have delivered a dividend, I think some 2,500 crores of dividend, although the corpus remains 3,500 crores. This is a unique achievement that for 30 years, a low risk product delivering consistent performance with a dividend attached to it. I think it's absolutely the right product for every middle class Indian household to consider.
Mr. Puri, very interesting. If we could look at this particular product as a benchmark and see how things have turned around for the industry in the last couple of years, with once again retail investors particularly coming back to the market. We had these discussions earlier also when I interacted with you. How do you see, because there is something, a good indication that retail investors are sticking to this market in spite of whatever volatility as and when it affects. How do you see that trend, and clearly mutual fund houses in that sense like UTI AMC emerging gradually but surely as the backbone of Indian markets, because we all know at the end of the day it's the FIIs or the FPIs who determine how our markets behave.
I think there is a genuine level of conviction amongst capital market investors that this time the reform process may be more deep-rooted than earlier efforts. So even though there has been global volatility, and our markets have of course reflected that, so far levels of redemption have been quite manageable. Of course there will be redemptions because people will take profits, and that's a healthy thing. But the panic redemptions that one has seen in earlier cycles are certainly not visible. And this comes from the conviction that India is, of course we know we are in a global sweet spot and so on, but more importantly there's a deep conviction that India is finally beginning to break the shackles of the past in terms of resistance to reform, and we are going to find a way to break this through. So this could be a longer cycle. It will have its volatile periods, but this is a long uptrend, a genuine reversal of fortune for the country, and in a way this is India's China moment. We have to look forward to the next 10, maybe 20 years or so now to actually close the poverty gap and establish ourselves as a middle income country. So what better time, if you like, to stay invested and to participate in this phenomenon.
Interesting statements, the India's China movement. Mr. Puri, in that sense, how do you see global investors, you interact with so many of them, looking at India at this point of time? Clearly, would this inflow that we are seeing into equity markets as well as FDI continue, and clearly India would be the market, say maybe perhaps in the next 5 to 10 years, in spite of the volatility or in spite of certain global economies getting downturned or whatever is happening around global, clearly these inflows would continue. How do you see this?
I think if you take an underlying view, the markets are well supported, and financial institutions around the world are very committed to increasing allocations to India. I think there is a genuine probability of a dislocation happening at some point in the next 6 to 12 months. And as that, I would therefore in a way tighten our seat belts and expect that dislocation. That dislocation will happen because of externalities, which I think have been well documented on your channel and elsewhere, that the fear of, if you have a dual Fed rate hike and you have ETF flows reversing, you have pressure potentially on emerging market currencies, you will see tactical reallocation, and that could have a significant impact in the short term on our markets. But if you look through that, I fully expect that the investors will actually return as the dust settles on that period of adjustment. It's very hard to predict exactly when that dislocation will happen.
So, and from a fund house perspective or even from an investor perspective, how do you see this particular markets? Still a high valuation, still a lot of potential at the current P's. How do you would as an investor investing in any of the listed companies look at this market?
So our research and investment process generates a view that says we do think markets are at this point fairly valued as markets go. But of course, as always, you end up looking for individual stocks, and that's naturally what our job is. As any professional fund manager is always trying to find this selective stocks which will enable the differentiation, and this is in that sense classically a stock picker's market. Whenever you get to a point where markets are fully valued, and you are, I think, in a position where you can start to see some upturn in earnings, not yet a universal phenomenon, but you have to start reading the tea leaves enough to be able to predict where the earnings momentum is going to build. And that's essentially what we are engaged on at this point, is to make a call as to when defensive, if you like, plays, time might be to switch out of defensive into more domestic cyclicals, if so, into which domestic cyclicals. There are fundamental shifts happening in the IT sector. One has to understand who are the winners and losers likely to be from that within the Indian firmament. But there's no doubt that we do have signs of earnings momentum picking up, and therefore there is an opportunity to pick stocks that still have material value embedded in them.
Mr. Puri, when you say there can be a phase of turbulence. Would domestic players, particularly the mutual fund houses, and also we know EPFO finally is becoming an important player in the market. UTI has been also selected as one of the fund managers very soon. I believe you will be starting managing their funds. How do you see this particular crucial domestic institutions playing a role in balancing this volatility that perhaps we could face because of global issues?
Absolutely. I think first, of course, we are very privileged. We have already been mandated and have started investing on behalf of EPFO. And the entry of strong domestic institutions into the capital markets is a very important development. And I think over the next 5-7 years will definitely be a stabilizing force in the market. So our market has been too dependent domestically, essentially on HNI and retail flows, and we have never really had a committed institutional investor other than, of course, the giant of all, which is LIC. So the broad basing of institutional investor participation is a very healthy development for the market and will help us stabilize. I also think they will need to develop the maturity to keep investing through cycles. That is a feature we do see institutions getting nervous. We see trustees getting nervous. We saw that when there was a wobble last year in the market. But with each cycle, I think the conviction builds. People see the turnaround. They understand that you will have to take a medium to long-term view. And that maturity will also help the market stabilize.
So EPFO, how do you see last FY16, I believe they invested close to some 6,000 crores into the equity markets. FY17, how much incremental fresh investments do you see happening? And secondly, of that, how much portfolio would you be managing?
At this point, we are getting 25% of the equity flows. I think that, of course, it depends on how the EPFO develops releases it, but it would certainly be more. It could be 10 to 12,000, but that will be their call. But we would get 25%.
So from UTI's perspective, I know you were one of the first when it comes to NPS as and when it was started. How are things panning out when it comes to the NPS vertical and the pension vertical for you?
It's a critical strategic initiative for us. I think longer term it will be a bigger corpus than the mutual fund industry in my view. It is in most parts of the world. We are fundamentally still underpenetrated in terms of the percentage of people's household wallet that has gone into long-term retirement savings. The government has created a wonderful product in the NPS. It is tax efficient, it is simple, it is remarkably low cost. It has to now be made more accessible. There is rethinking on that. Perhaps some incentivization for distribution could be considered. But overall, I have no doubt the NPS will succeed longer term. And the EPF is already a very well established product for its own segment and sector and will also continue to grow. Alongside that, you will see mutual fund linked retirement plans, you will see the IRDA linked plans. So overall, more and more long-term money will essentially come into the market through this institutionalized format. So pensions is an absolutely core business for UTI.
Mr. Puri, before I could wrap up, a couple of important questions. So the one area which we have seen once again a lot of debates happening is the whole area of the non-compete fees, particularly happening when it comes to M&As. The recent being we all know HDFC Life and Max Life. The industry also has its own views. That time I knew you were heading AMFI. How do you see this whole debate, and is the time once again come to relook at the non-compete fees as a option during these M&A activities? What's your view?
Well, I think the regulator should examine many such facilities that currently exist. See, there was a time when corporate India was developing where entrepreneurs needed certain help and certain facilitation, certain assistance, if you like, as they went to market. I would put preferential allotments, for example, in the same category as non-compete. There were reasons why these were needed to avoid excessive dilution and so on. But if you look at the way our markets have developed today, I think it's the right time to examine, do we really need these any longer? Should they be legally permitted at all? Should we permit a non-compete or a preferential allotment process under any circumstances? Why permit it and then ask questions later when these facilities are used, when this incidents arise where promoters use them. If you give somebody the right to use a particular approach and it's legally permissible for him to do it, he will do so. And to then turn around and say, well, institutional shareholders should prevent this is not always realistic, because typically the voting patterns and so on will be such that they will be able to ensure that this happens. So we are serious about thinking about this. The regulator must take the lead on actually systematically reviewing whether these are still required, and if not, I think we should now remove them from the statute book altogether.
Hope the regulator starts that discussion process. Lastly, Mr. Puri, if I could ask you to wear the hat of an economist, how do you see the macro picture? We all know the big ticket GST all set to roll out from April 1st, 2017. Ease of doing business, a lot of things have been done, a lot of reforms taking place, FDI all-time high. How do you see now with the budget also going to be preponed? Where do you see things further needs to be done to ensure that the momentum continues?
As you say, we have a very favorable tailwinds in terms of our macro on all of these fronts. I don't think we've had such a coincidence of benefits actually helping the economy. At this point, I would simply say deepening and accelerating our commitment to structural reforms is the need of the hour. Above all else, we need to do that precisely because we have a favorable macro. If we can't deepen and accelerate when we have a favorable macro, we will certainly not be able to do it when we face headwinds. So our number one priority is deepening and accelerating the pace of underlying structural reforms, liberalizing the economy, making sure we are more connected globally to international trade and capital flows, and addressing some of the long-running difficulties we have faced on the use of land and labor in this country. Without a doubt, that is the number one priority, and I think we are making good progress there.
Okay, my last question. One thing with the whole corporate India is hooked on to the last 5 days is what is happening at the Bombay House in the board of Tatas. Are fund managers like you or fund houses like you getting jittery with whatever is happening, the letter war or the news coming out? How are you looking at this?
While much of the citizenry and the media are highly titillated by this event, as a professional fund manager, ultimately we will wait to see the facts. Our concern is always that we need to understand what the true underlying facts are. So far, there have been very little facts that have actually been shared around developments. The developments are clearly very serious. We do need to take note of them, but we don't wish to react to what we see as being merely speculation or interpretation or people apparently speaking on behalf, with or without authority, of one party or the other. So I think we are keen to understand the facts. We are sure those facts will be available to us in the next few days, and it's only at that point that we would form our opinion. And I think in the meanwhile, we really would not wish to comment on the likely direction of this whole process.
But Mr. Puri, Tata's, which has always been considered the benchmark or epitome when it comes to corporate governance, so on and so forth, do you think this would have an impact particularly on the sentiments on corporates, particularly the foreign investors who are looking at India? How do you see this? Because clearly this has really come as a surprise to everyone.
Actually, what has surprised me is how quickly people have leapt to conclusions on all sides. Most sophisticated global investors are taking the position I described earlier, which is certainly the position we are also taking, which is you must wait to understand the facts before you reach an opinion. It is actually quite astonishing how on both sides of this debate such strong positions have been evolved and taken and are being broadcast with such conviction, with no facts underlying them whatsoever. So we are seeing a shadow game in effect at this point. And I think we have to calm our minds and not be influenced by this stimulation that currently is hitting us through social media and other channels. I think we must await the facts. I am sure there is a good explanation. You are, as you say, dealing with one of the finest houses in the country. It is very unlikely that anything has been done by anybody in this case, whether on either side, without a certain amount of thought. And I would not at this point reach a conclusion that corporate governance has been irrevocably damaged. As the facts come out, I think we will get the explanations, and I would therefore not be so alarmist at this stage.
We need to wait for the
We
dust
must
to
wait for the
settle down.
facts. I think we must wait for the facts and not start alarming ourselves and exciting ourselves at this stage.
Mr. Puri, once again, thanks a lot for spending this time. Pleasure talking
Thank
to
you
you
very
as
much.
always.
Yeah.
Sir.
Thank you, Vijay.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ET NOW Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.